Hello, and welcome. For generations, family farms have been the backbone of our countryside, but the way they're passed down is facing a seismic shift. For decades, a powerful tax shield has protected these legacies, but that's all about to end. The experts at ProTax Accountant have put this guide together to help you navigate what's coming, and crucially, what you can do about it. So let's get straight to the question that's probably on your mind.
For so many farming families, this isn't just a hypothetical question. It's a very real and growing fear. A sudden, unexpected inheritance tax bill could genuinely threaten everything you and your family have spent a lifetime building. The rules that have provided security for so long are being rewritten, and honestly, the clock is ticking.
So, to make sense of all this, we're going to walk through it step by step. First, we'll look at the threat inheritance tax poses. Then we'll understand the old rules that used to protect farms. After that, we'll dive into the massive new rules coming in 2026. We'll even look at a real-world example, map out your crucial planning window, and finish up with how you can get the expert guidance you're going to need.
Right, let's set the scene. Inheritance tax, or IHT as it's known, has always been this potential shadow hanging over family farms. The thing about a farm is it's often incredibly asset-rich, with land and buildings, but cash-poor. And that combination makes it uniquely vulnerable to a big tax bill.
So here's the bottom line. Anything in your estate above your tax-free allowances gets hit with a pretty hefty 40% tax. Without special protection, passing on a farm could trigger a tax bill so huge it might actually force a sale. For decades, the government recognized this and provided a vital lifeline, special tax reliefs just for agriculture. But that lifeline is about to get a lot shorter.
So how exactly did that protection work? Well, the specific tax shield we're talking about is called Agricultural Property Relief, or APR for short. And for anyone involved in farming, APR has been the absolute cornerstone of succession planning for generations.
In simple terms, APR was designed to stop farms from being broken up and sold off just to pay a tax bill when the owner died. It meant that the land, the farmhouse, the buildings, the very heart of the farm, could be passed on to the next generation without triggering that massive 40% tax charge. But what made it so incredibly powerful?
This, 100%. For assets that qualified, the relief wasn't just a discount. It was a total 100% exemption from inheritance tax. And crucially, there was no cap, no limit. It didn't matter if your farm was worth 1 million or 10 million pounds. If it qualified, it could be passed on completely tax-free. This unlimited relief has been absolutely fundamental to the survival of family farms right across the UK.
Now, it wasn't just a simple rubber stamp, of course. To get this 100% relief, you had to meet some pretty strict conditions. Broadly speaking, you either had to be farming the land yourself for at least 2 years, or you had to have owned it for at least 7 years while a tenant farmed it. And it's really important to remember the relief only ever applied to the agricultural value, not any potential hope value if the land could be developed.
And this brings us right to the heart of the matter. Stay with me now, because this is where things get really, really important. On April 6, 2026, the era of unlimited relief is over. This is, without a doubt, the single biggest change to agricultural inheritance tax in a generation.
Okay, let's break this down side by side, because this table really shows the new reality. Before April 2026, no cap on 100% relief. After, a hard limit of 2.5 million pounds. Before, there was no such thing as excess value because it was all covered. Now, any value above that 2.5 million cap only gets 50% relief. There is one bit of good news, though. Any unused part of that allowance can be transferred to a surviving spouse, which adds a completely new and vital layer to your estate planning.
Let's just focus on this number for a second. 2.5 million pounds. After years of back and forth, this is the figure the government landed on. This is your new ceiling for 100% relief. And remember, it's a combined limit for both your agricultural property relief and any business property relief you might have.
Okay, here's a quick pro tip to make sense of that 50% relief thing. It sounds complicated, but here's what it really means. It just halves the standard 40% IHT rate. So for every pound of your farm's value over that 2.5 million pound threshold, the effective tax rate is going to be 20%. It's still a big tax for sure, but it's not the full whack.
All these numbers and percentages, they can feel a bit abstract, can't they? So let's put some real-world figures to this and look at how it works in practice for a typical family farm. This is where the reality of these changes really starts to hit home.
So, let's meet the Thompson family. They're a family who have farmed their land for generations.
After getting everything valued recently, their entire operation, the land, the buildings, the farmhouse, is worth a solid £4 million. Under the old rules, their succession plan was pretty straightforward. But now?
And wow, look at the difference this makes. Before April 2026, the Thompsons could pass on their $4 million farm with an inheritance tax bill of zero. Nothing. After April 2026, it's a completely different story. The first $2.5 million is covered, that's fine, but that leaves $1.5 million exposed. And as we just learned, that excess gets taxed at an effective rate of 20%. And 20% of £1.5 million is a sudden, brand new tax bill of $300,000. Now, where does a working farm find that kind of cash?
Now, to give this some context, the government reckons that about 85% of estates that claim this relief won't actually be affected by the new cap. But that still leaves a significant 15% that will be. In the first year alone, that's expected to be around 185 farming estates facing a new and potentially huge tax bill. The big question is, will your farm be one of them?
But that's not all. Here's where a lot of people could go wrong. We really need to talk about a hidden trap in the rules. It's incredibly easy to fall into, and it could cost your family an extra £175,000 in tax.
Did you know this? Most people don't. On top of everything else, there's a separate home allowance called the Residence Nil Rate Band. It's worth £175,000 when you pass your main residence to your children. But here's the brutal catch. You start to lose this allowance if your total estate is worth more than £2 million. And here's the trap. The taxman looks at your farm's value before any reliefs are applied. So your farm, which might have a zero tax bill thanks to APR, could still be considered over the threshold. This means you could lose that entire $175,000 home allowance, creating a tax bill where you thought there wasn't one. It is a really nasty surprise just waiting for the unwary.
Okay, so understanding the problem is one thing, but what can you actually do about it? Let's look at the next step. We are now in a really critical planning window, and there are certain actions you need to think about before some key dates if you want them to be effective. The rules around making a lifetime gifts are especially tricky right now. Any gifts made before the 30th of October 2024, they're safe. They fall under the old unlimited relief rules. But we're now in what I'd call the danger zone. For any gifts made between late 2024 and that April 2026 deadline, there's a catch. If the person making the gift passes away within 7 years, that new $2.5 million cap can be applied backwards to that gift. It means an action you take today thinking it's tax-free could end up triggering a massive tax bill years down the line. That is a crucial detail you have to understand.
So, what should be on your to-do list right now? Number 1, you can't plan if you don't know your numbers. Get a full professional valuation of your entire farm and any other business assets. 2, your will is probably now completely out of date. It needs to be reviewed immediately to work with these new rules. 3, you need to seriously look at your strategic options, things like lifetime gifting or using trusts, and weigh up the pros and cons. And finally, and this is the most important one, this is not a do-it-yourself job. You absolutely must seek expert tax advice that's tailored specifically to your family's unique situation.
And that brings us to our final and maybe most critical point. The entire landscape has changed for good. Protecting your family's legacy now demands a completely new level of planning and expertise.
If there's one thing you take away from this, let it be this. The simple blanket protection that farms have relied on for decades, it's gone. Just relying on the old assumptions could lead to a really devastating financial shock for your family. Proactive, professional planning isn't just a good idea anymore. It is absolutely essential to protect the future of your farm. The question you should be asking isn't if you should plan, but how and when.
And of course, a quick disclaimer. The information we've shared here is for general guidance only, and it doesn't constitute professional advice. Every family situation is unique, so you really shouldn't act upon this information without getting specific professional advice that's tailored to your own circumstances.
Look, these changes are complex, but you do not have to figure them out on your own. Take control of your farm's future today by speaking with the specialists. You can get in touch with the team at Pro Tax Accountant directly by WhatsApp or phone on 07985 689 912, or you can drop them an email at info@protaxaccountant.co.uk. For more updates and clear explainers just like this one, make sure you subscribe to their YouTube channel. Thank you for watching.